Hi friends, today's first business standard editorial is titled Strengthening Oversight. It is talking about the growing lapses in the audit firms of our country. So the recently published inspection reports by National Financial Reporting Authority highlights many worrying lapses in the quality of some of our country's top audit firms. Now, what is National Financial Reporting Authority? It is an independent government body that regulate auditing and accounting standards in India. NFRA was created on October 2018 under Section 132 of the Companies Act 2013. By being an audit regulator, it replaced some of the roles usually done by ICAI, that is Institute of Chartered Accountants of India. NFRA has many core functions, but in the context of this news, it is talking about being an auditor of auditors. It conducts regular audit quality inspections, and the reports of those inspections are released before March end every year. In these audit quality inspections, it checks if the auditing firms like PwC or DSR, SRBC, etc. is complying with the auditing standards and that there are no lapses in the auditing quality, no related party transaction, and so on. Does it do the inspection on all the audit firms in the country? No, it selects certain audit firms, and in this financial year it expanded its audit inspection to 35 to 40 firms from 25 previously. Now, what all deficiencies did it find in the system? Audit independence, audit documentation issues, fraud risk assessment issue, and scrutiny of related party transaction. What are each of these things? Audit independence means an auditor must remain objective and they should not have any financial or personal ties to the clients, that is the firms that they are going to audit. Audit documentation. It means the auditor should check all the supporting documents, records, and evidences before giving their audit signature. This was also violated. Fraud risk assessment. It means the auditor should find out a fraud that has risk implications like revenue understatement or overstatement, cash siphoning by senior management, etc. This was also violated. Scrutiny of related party transaction. It means the auditor has to check if any transaction has happened like unusual loans, investments to subsidiaries, selling items to parent company at discount, etc. Basically, it has to check if every transaction is done at an arm's length. Arm's length means it treats every company equally without any bias. Some real life lapses that NFRA found out in its inspection was that the audit firms failed to check if the loans given to subsidiaries were done at arm's length. If a company is facing an ongoing investigation by CBI, the audit firms fail to properly evaluate its impact on the company. The audit firm lag in conducting the background verification of their employees. This will allow fake CAs to work on audits for at least a significant period. The audit firm has partners who have financial interest in the company they are auditing. Why such lapses occur? A single firm could have both auditing division and another consulting division under its wing, which is very common in the big four consulting firms. If both the divisions are having the same client, then there is chances that compromises will happen. Why? Because consulting is the lucrative business, and if auditing division flags certain risk, then the client may choose not to work with the consulting division either. Modern companies have intricate corporate structures such as different subsidiaries working under different structure in different countries. This makes it difficult for the audit firms to make 100% verification. Audit firms also lack in the adequate number of professionals, which leads to weak supervision. How to address these challenges? Clear separation of auditing division from non-auditing divisions of a firm and ensuring accountability from partners if something goes wrong. Usually they blame the firm if anything bad happens. Audit firms must recruit more professionals and their background verification must be done instantly, and they must be trained in complex areas such as forensic accounting and valuation. Audit firms must make use of the technology like AI, advanced data analytics, and real-time risk monitoring. This improves the audit quality and reduces human error. On the part of NFRA, they must coordinate more with the ICAI to ensure consistent enforcement of standards. Every company will have an audit committee that looks after the audit process. They must demand higher standards of scrutiny and transparency from auditors. In summary, India is trying to attract large investments from global investors. Under such scenarios, we must ensure that our financial reporting framework is top-notch. Thank you.